Good afternoon. So let us continue with the third session in the series Learning Technical Analysis. So in session one, a quick recap. In session one, we understood the hypothesis behind price action and why the study of it may be useful, since we deduced that all the information about a security is reflected in its price. Therefore, study of the price can help us inferring all the information that is there, relevant information that is there about a security to take meaningful decisions in the market. Next, we understood how to interpret this price via use of candlesticks, and we did not discuss that too much in detail. We simply said identify the color to note the relation of the opening with the closing. That is, if the color is green or white or anything that represents a positive move on your chart, it implies that the closing was higher than the open. And if the color is red or black or any negative any color that implies a negative move in your chart, we understand that the closing is lower than the open. And the wicks in both cases represent the highs and the lows. Now, when these candlesticks are laid out, we understood that they're aesthetic, easy to interpret, and what they end up doing is they give us a visual assessment of the trend. So this is what today's session and a few pointers from here will be directed at to understand the trend. In our first session, we had a look at the Nifty IT chart, and today we'll be reinforcing some of those key points which will help us hopefully take better decisions in the market. So let's get started. Uh, so we are now on the slides of trends, and what this so the first point here basically says that the trend generally indicates the change in price and the direction of the change in price. It is fairly obvious. Now, trends. The interesting point that we want to note here is that trend can last decades. All right, that's why the word trend is there. So we have seen this historically play out, and what I have done is to uh, reinforce this point that trends can last decades. Shared the example on the next slide, where I have taken some very commonly traded currencies in the global FX market and even in the Indian currency derivative segment. In this table, what I have done is I have just outlined the prices, and we can see how the fundamentals played out with respect to these prices. So let's begin with the USD INR. In 1972, we have the base. So we know Bretton Woods actually took place, and the gold standard was sort of abolished. In 1972, at that point, the ratio of our currency with the US dollar was 6 is to 1. In 1982, this price became 8 is to 1. So, what did we learn from this simple 10-year price change is that the dollar, you could say, appreciated by 30% against the rupee, which is not very good for the country. If your currency loses its value, things in your country become expensive. And which also means that these phases where the currency lost value would have been characterized by inflationary price moves. Now, from 1982 to 1992, so if 30% was bad, we did a wonderful job in that decade where we lost 300% against the dollar. Now, 1992 we know was the balance of payment crisis. This is basically when the Indian market and the Indian government norms of extra protectionism were taken to task, and it was and the Indian market had to open itself up to foreign investors, thereby liquidating key stakeholdings in internal assets. But nonetheless, this had to be done in order to stabilize the currency, because if you lose 300% of your value, the prices, the overall macroeconomics of the country is just completely jeopardized, and that reflects in the form of extremely low standards of living. Now, this is a fundamentally not a very good sign for any economy to be in, where your currency loses valuation at such a pace. And this is exactly where we were. So, if we remember that in the year 1992, 90s, if anyone traveled abroad, they almost tried to bring home a TV, VCR, etc., because these things were not available in India at the time, because we were a closed economy. And if someone wanted to sell these things like a camera or a phone, they were heavily taxed. So these things started changing after the year 1992. By 2002, we see a 50% decline in valuation, which shows the relative stability the economy. I mean, even after losing 50% of its value, we will say that by this much time we had started achieving some degree of stability in the overall economy. However, things are not very good, and usually a phase in which your currency loses value at like 30%, 50% in a decade, the people of the country, the working class of the country, want to leave that place, because your job appreciation is usually not as high as the currency devaluation. And what you want to do is you want to go and work in a country where you are paid in a currency which is structurally appreciating against your home currency. And in that year, not year, in that period, you will see a huge, I mean, you would have been, even in the past, you will see that a lot of Indians from who were getting educated from the period 1975 till 2000 particularly, were very keen on leaving the country and going abroad to work. It was a part of their overall agenda of study. By 2012, we have declined another roughly 45 percent to reach a level of 6970. This is still not very healthy, and but okay, I mean, it is much better than complete erosion. And now the interesting point is the latest fundamental development, wherein from 2012 till 2020 we have not declined against the dollar significantly. That is, the decline against the dollar is actually significantly lesser than the increase or the overall inflationary pressure in the economy during that particular period of time. What this basically means is that if your currency is at a constant price with the global currency, relative to what it has been in the past, if you note the changes in price, so say for example, what was the flight of, say, a Mumbai Delhi flight in 2012, the fare of that flight is more or less the same today. Whatever was the education fees of your postgraduate MBA, B schools, etc., the same is almost the fees even today. Whatever was the cost of real estate at that time, the same is the cost of real estate today. This has got to do with the fact that the currency is no longer devaluing, which means lesser units are required to purchase the same product at the same quality, and therefore the price does no longer appreciates at that pace. This becomes a phase in which the growth rate becomes lesser, but the quality of life starts becoming higher. And the stronger your currency is against the global currency, the more value per unit rupee you actually own. And so the key point here is that if we look at 1972 to 2012, it's a 50-year move that the dollar had, in which it appreciated over 1100% against the rupee at an average of 5% per year, and 85% per decade. Now, had this trend continued from 2012 to 2022, estimating a roughly 85% collapse in the rupee, we would have put the rupee dollar valuation more at 120. But what we are getting is that it is 2020 and the rupee dollar is still at almost constant. So the highest it has made is 77 and the lowest it has made is 68 during this phase. I mean 64 during this phase. So we are getting it at a mid value point. And what this basically means is that when you get 5% interest on the rupee, essentially, if the rupee is not moving that much against the dollar, someone is paying you 5% interest on the dollar, making the Indian bond market exceptionally attractive, bringing in extreme amounts of FDI, which in turn raises your country's forex reserves. And it's a cycle by itself. Compare this to a contrast to, say, Turkey. Now USD TRY, so Turkish Lira, in 2002, I mean that's the data I could find it for. In 2002, a Turkish lira, I means 1.35 lira were $1. And actually, I have visited Turkey in 2002. So I know this, that this was really actually more or less the value around that 1.2 types. But yeah, but what I found was that the Turkish lira was 1.35 to the dollar. By 2012 it is 1.75. So we have seen a decline of roughly 30% now in the decade in the Turkish lira. But look at what happened by 2022. This is when I mean, now we clearly know the major fundamental changes that have happened in Turkey, particularly in the last 5 years. And this has actually those fundamental changes of a slightly more authoritarian government, a slightly more business unfriendly government, is clearly reflected in the overall valuation of the Turkish currency, where it loses now more than 300 odd percent against the US dollar in the 8 years. So in from the period 2020 to 2012 to 2020. And a similar such price action can be seen vis-a-vis its value in the rupee. Now what this basically means is that Turkey is going through the same phase that the Indian economy went from the period 1982 to 1992. So if we have to use our understandings of what happened in the Indian economy, what will happen is that most likely Turkey will go through an inflationary pressure. The citizens of Turkey will want to leave Turkey. And then there becomes a state of social unrest in the economy. The economy needs to bail out. In order to bail out, it needs to agree to the then global trading practices and diplomatic practices. The economy then adjusts, and it takes a period of, for a country the size of India, it took approximately 2 decades. Maybe a country the size of Turkey, it could take lesser time. So then it takes that time to stabilize, and then you will begin to see a slightly more stable currency change. And with this, now when you understand that trends can last decades, but the forex market is the ultimate proof of concept. And if you find the opportunity to trade forex pairs, it is without doubt that you can consider going long Japanese yen and Swiss franc against almost any pair in the world. They are fundamentally rock solid and very stable. And understanding of the trends of these currency pairs starts giving you the first macro level understanding of the country that you are going to be trading the businesses of. You can do a similar analysis on the interest rates, etc., and you will start finding a direct correlation between high interest rates, high inflation, high currency devaluation with high GDP rates. And you will begin to start wanting a situation where your currency remains stable, where your inflation remains stable, where you get money for putting money in the bank, but yet you want high GDP rates. And that should tantamount to good law and order and good quality of life, and good health and education. So all of this combined is basically what we say represents the fundamental of a country. And using price action on macroeconomic tools is a good way to begin to start understanding the fundamentals of the country. Anyways, coming back, I hope that is clear. It should not. It's fairly simple. I mean, and I will repeat some of those key points as we go along. Anyway, so just completing this slide, we can see that trends can be assessed visually. We had done this for Nifty IT. In order to assess for an uptrend, we are going to see the relation of the lows and the highs, consistency of higher highs and higher lows, and vice versa. For a downtrend, we will see lower lows and lower highs. And we want to see inconsistent highs and lows for ranges, and we want to use our database of understanding of patterns to identify which of these ranges are a pattern. Subsequently, in the next slide, we will try to now quantify a trend, its strength, by using some broader indicators, and then work towards perhaps maybe doing some macro level analysis of the markets ourselves. So yeah, that about concludes this video. If you find this useful, relevant, and you think that it adds value to you in some way, do like, comment, subscribe. And if you would like to continue being see these videos as they come, do hit the notification button. All of this helps us promote our work. Thank you for your time. Have a good weekend. Regards.